Just close your eyes and picture your retirement savings. The capital you worked decades to build securely. Now imagine that money being quietly reallocated, without your direct permission and completely without your knowledge, to buy into a company currently losing billions of dollars at one of the largest private valuations in market history. This company is now valued higher than Coca-Cola. It outweighs McDonald's and Disney combined. It surpasses Nike and Starbucks. How did your hard-earned savings get positioned into this trade? Who quietly adjusted the rules of index inclusion? And why might the biggest upcoming tech IPO be a liquidity trap? What if the narrative isn't about rockets? What if it's actually a massive capital exit strategy? Who really benefits when passive funds are forced to buy? And what structural shift just rewrote market mechanics? If you want to understand how capital actually moves in modern markets, make sure to subscribe to FinSmart Daily. We break down the real math behind market shifts so you can protect and grow your wealth with clarity. Chapter 1. The Illusion of the Rocket Empire. Let's look at the valuation mechanics behind this holding structure. Most investors think this company is purely a launch provider. Some assume it's a deep space colonization play. But from a financial standpoint, both of those views miss the actual revenue architecture. The entity operates as three distinct business segments bundled under one consolidated valuation, and the launch division isn't the primary profit driver. Let's start with the segment drawing the most media coverage. xAI is the artificial intelligence laboratory founded to compete directly with OpenAI. Recently, it was folded into the broader corporate valuation at a staggering $250 billion mark. But here's where the financials get complicated. Earlier this year, key leadership departed. The CEO himself acknowledged the infrastructure needs a complete rebuild. The market priced this at $250 billion for assets that are still in heavy development. OpenAI generates billions in revenue with a more grounded valuation. xAI, meanwhile, is in a capital expenditure phase with minimal current revenue. The market is pricing it like a mature tech giant, but operationally, it's still burning cash. It's just one segment of the larger structure. The other two divisions are where the actual cash flow lives. Chapter 2. The famous rockets and their true value. This is the segment everyone visualizes. The launch division handles government contracts, satellite deployments, and NASA crew missions. Last year, this division generated roughly $4 billion in revenue. That sounds massive on paper, but when you stack it against a $2 trillion valuation, the math changes quickly. Launch services only represent a fraction of the total enterprise value. This brings us to the actual revenue engine. The third segment is what's really funding the balance sheet. Chapter 3. The crown jewel printing cash in space. This is where institutional investors are actually placing their bets. Starlink is a global satellite internet provider operating in low Earth orbit. Structurally, it functions as a high-margin telecom network. There are over 10,000 satellites currently deployed. They beam connectivity directly to consumer and commercial receivers. The user base has scaled to over 10 million active subscribers worldwide. Last year alone, Starlink generated roughly $11 billion in revenue. That's approximately 60% of the consolidated top line. But the revenue number isn't even the most critical metric. The operating margins are what catch the attention of financial analysts. Margins have expanded from 40% to over 60% in recent quarters. Add in classified defense and government contracts, and you have a highly scalable, cash-generative infrastructure business. Starlink isn't just consumer broadband. There's a maritime tier for global shipping, an aviation tier for commercial airlines. It's scaling faster than legacy telecom providers. The hardware self-aligns. The satellite mesh network operates autonomously. Industry leaders call it one of the most defensible tech infrastructures built in the last decade. But remember the AI segment we just covered? When you consolidate the heavy R&D spend from xAI with the capital expenditures of the launch division, the consolidated entity still reported a net loss of roughly $5 billion. Growth is there. Profitability across the full stack is still being engineered. Chapter 4. The hidden rule, change in the market. So who absorbs a multi-trillion-dollar valuation when the consolidated entity is still posting losses? The answer is straightforward. It's you and your retirement accounts. This is where market structure actually shifts the playing field. The index providers recently adjusted their inclusion criteria. The flagship tech index is the benchmark for institutional capital. Billions in passive funds track it automatically. Once a company is added, index funds are mechanically required to purchase shares. This creates immediate non-discretionary demand. Under the previous framework, new listings had to wait a minimum of 3 months. That cooling period allowed price discovery to stabilize. The updated rule compresses that window to just 15 days. It accelerates passive inflow before the market fully digests the valuation. They also eliminated the minimum public float requirement. The company currently has only about 5% of its equity available for public trading. Under the old guidelines, that would disqualify it instantly. Now it qualifies for index inclusion. There's also a structural multiplier in the weighting formula. The index now calculates the free float as if it were significantly larger. This essentially manufactures passive demand at scale. This isn't just about one IPO. Other large-scale tech and AI companies are preparing to list. They're all positioning for the same structural advantage. Chapter 5. The exit liquidity hiding in your account. Here's the critical mechanic most retail investors miss. The buyers and sellers in this scenario are structurally mismatched. The buyers are passive index funds forced to purchase on inclusion. The sellers are early investors and insiders sitting on deeply discounted cost bases. Shares will transfer from private holders to public index funds at peak valuation multiples. Your 401k and brokerage accounts become the absorption layer. The company has already signaled that roughly 30% of the offering will target retail and passive channels. The CFO explicitly told institutional bankers that retail participation would be historic. They're structuring the distribution to maximize liquidity uptake. Capital moves from low basis private holders into high multiple passive funds. If you hold any broad US equity index fund right now, you will automatically own this position within weeks of inclusion. You won't vote on it. You won't opt out of it. The index mechanics will simply execute the trade. Traditional financial media focuses on the launch spectacle. It's an easy headline, but index rule changes that engineer passive demand don't make front page news. Passive investing was marketed as efficient, low fees, broad diversification, automatic market capture, but the structural reality is rarely discussed. The same automated buying mechanism that works in your favor during bull markets also forces you to buy whatever gets added to the index. It executes without your direct input. The feature that simplifies investing also makes you a guaranteed liquidity provider for private capital exiting at peak multiples. And right now, that mechanism is being activated. What's your take on how index mechanics shape modern market valuations? Drop your perspective in the comments below. If this breakdown changed how you view passive investing and market structure, hit that like button and subscribe to FinSmart Daily. We break down the real mechanics of capital, market structure, and wealth preservation every single week. We're just getting started on mapping how modern markets actually allocate capital. Until then, always verify the mechanics behind the narrative. The math never lies. Thank you for watching, and I'll see you in the next video.